All right. Evening, everybody. How are we? Claudio, Food Dweller, Andy. Thanks for joining me. How is everyone? Hope everyone stayed safe this week with obviously all the storms and everything that's going on that happened. So I am on a bit of a time scale, unfortunately, this evening. So we're going to give this a good hour, see what questions we can answer because my the week next week is mad, and then the week after that is also absolutely crazy. To the point that I'm actually struggling a little bit with actually getting some videos planned out as well. But anyway, I do appreciate every single one of you for being here. Thank you so much. Let's have a look and see who we've got. We've got Claudio, Food Dweller, Andy, you're here. Anna, you're here. Welcome. Otis. All right, good to see you guys. Let's have a look and see. Let's have a look and see what questions we actually have here. To be honest, I have been so busy all the way through the week. I've not paid any attention to what's going on in the markets at all. We started shooting for Channel 4 this week, so I've had is it 3 or 4 days worth of shooting? I think I've had 4 days of shooting this week. I've got two next week. Then I've got 5 days shooting next week. The week after next. So we're all go at the moment, and extremely, extremely, extremely busy. So I've not paid any attention to what's going on with the markets right now. I know that Bitcoin's still down. I know that the CPI numbers for America were rubbish. We kind of touched on that a little bit last week with Rallick. But looking at the UK, I also know that we're now, it looks as though inflation is going to be hitting 8% in opposed to 7% by the time we get to April. And April is literally just around the corner. So, all in all, it's not great news, to be honest, particularly if you've got money sat in an account right now. I was going to do a video around staking, so on and so forth, but to be honest, I've just not had the time to put to actually put my money into it and see how it goes and actually contextualize a video that would make sense to do so. But staking seems like a good option to go, although it does have obviously its downsides, and that's kind of what I wanted to give in a video if I do that. But yeah, it will be in a few weeks' time once I've got through all the busy schedule shooting for Channel 4. Anyway, let's have a look and see what we've got in terms of some of the questions. Otis has got his popcorn. Good man. I like it. Any updates for Trading 212? No. It's strangely, this week I noticed I got a couple of messages saying I've got a free share coming from people who have used my referral link. And that's weird because I've not spoken about Trading 212, it feels like, for a year now. And I've certainly had nobody that I'm aware of use my link for a year. So unless those people are in Europe, maybe, because I know that they are onboarding new people in Europe. They might have been in Europe, but I know that I had 2 free shares last week as a result of that. But I've had no update at all from Trading 212 in terms of what's going on with the UK market. It is literally a year now since they stopped opening accounts for UK citizens, which I don't know what's going on, mate. And they are relatively quiet about what's going on as well. I know they have been opening accounts in Europe, but I've got no update for the UK, unfortunately. Cheers for this, Andy. I appreciate that. I know that people get busy and stuff like that, so it's only rare that we have like really like people watching the stream every single week religiously, either live or in reruns. I know a lot of you do watch them in reruns, so I appreciate every single one of you. And Andy, you've always been here as well, so yeah, I appreciate it. And yeah, I am fully recovered from COVID now, thankfully. NSL. Okay, let's have a look at this. Hi, Pete. I hope you're well and safe. Question. I've been doing research on staking and think it's a good way to generate income. Any good staking platforms you are aware of for beginners? The only platform that I was going to do a video on to potentially cover was crypto.com. And that's only because I actually had a conversation with one of their representatives, and I had him walk me through it. And I asked them a lot of questions. I've just haven't got round to actually making the video just yet. So crypto.com is probably the one that I will do a video on. I'm not saying that that's obviously the best one for beginners, but it's certainly the one that I would probably make a video on to kind of explain how staking works. If I do a video on staking, I said before that I was likely going to put some of my own money into a stake, and I'll probably do it with them because they do have some really, really good rates on there. But again, you have to do your homework in terms of how it actually works, because staking is great, but what's the trade-off for the returns that you're going to get? That's obviously really, really important. So make sure you just understand how it all works more than anything else. But crypto.com is the first one that pops to mind, purely because I've had a conversation with them in the past. Evening, Edna. Welcome. GT Playboy, how's it going? Claudio's saying markets look dirty. Yeah, look, whenever we're in situations like this, markets are going to be volatile, and like we always say here, you kind of have to weigh these things out. This is what happens with poor economic news, poor economic forecasts, poor economic outlooks. You've got the whole thing going on with Russia and Ukraine as well to add fuel to the flames. What impact that's going to have, I don't know really, to whether it's going to have a significant effect or whether it would just be a slightly, minor effect. We don't know. But again, I had a question on one of the videos that I got to this morning, and it was someone who'd only just started to invest over the last month. And I'm thinking I might actually just do a video on this. And the question was, how do you decipher misinformation? How do you know what is good information, what isn't? And apparently the person had been obviously reading, obviously financial news, so on and so forth, and they thought it was misinformation. And I take a lot of my news from financial news and a lot of my updates from financial news, purely because regardless of how skeptical you are of markets and the people reporting on things, they still have a journalistic responsibility to be at least present the facts in the fairest way possible. Not saying that always happens, it doesn't, but I would rather get my information from financial news outlets like Bloomberg or places like that than just anybody here on YouTube. That's just the way I think. And, financial publications from investment houses, I'd rather get my information from those sources. Misinformation will be out there, obviously. And I think the key to deciphering whether something is misinformation or solid information solely lies in your ability to understand how the markets actually work from a fundamental point of view. And that isn't something that you're going to gain overnight. It will take a little bit of time, obviously, learning, experience, that kind of stuff. But if you get a fundamental understanding of how the markets tend to behave and what tends to lead to a market correction, there are multiple things. It's not just one thing that will lead to a market correction. There are a whole host of things. At this point in time, the thing that looks like is going to be the catalyst to this next market correction, if it does happen, is QE, interest rate hikes, inflation. Those are the three main things, really, to be honest. Last time in 2007, 2008 was something completely different. It was irresponsible lending. So there's a lot that could contribute to a market crash or market correction. If you get a general broad sense of how the markets tend to operate, what tends to move share prices and markets, that will always give you a good barometer to understand whether what you're hearing or what you're reading and what you're seeing is either has a tinge of misinformation to it or not. You can't always get it right, though, because whilst it does take some discernment, we're not all perfect. We can't all tell what is absolutely spot on 100% of the time. So the ability to take in information and be able to internalize it and interpret it in your own mind, based on your own beliefs, based on what you're reading and what you're opinion of things are is absolutely paramount. It's really, really important. It's not just taking information and taking that ad verbatim. It's taking it as right. Okay, but I was under the impression that these were some factors. Well, does that ring true or does it not? And if it does ring true, okay, what elements do you find valid? What elements do you not find valid? It's really, really difficult. It takes time and experience. On the podcast tomorrow morning, I'm speaking with an investment manager. Actually, we're actually talking about the market specifically, and interestingly, when I listened back to the conversation that he and I had for the podcast, we never really spoke about how the markets in particular were impacting the portfolios that we have, or certainly his portfolios, because the portfolio was built, or at least his portfolio has been built to withstand the possibilities that we're going to go into a market correction. And I think sometimes that is the most important thing for us to bear in mind. A lot of the time we'll buy things based on news, based on hype, based on vibes, right? As he called it. I like the phrase vibes, as he called it. And forget some of the foundation, the fundamentals of it. And the way I'd liken this is, you'd build a house with a solid foundation, and you'll look for the materials to set that foundation based on the reliability of those materials. You wouldn't buy material just because it's the new shiny thing. If there's something that is absolutely tried, tested, and proven to be the best thing to lay a foundation on, that's what you would use. Same kind of thing goes with investing here. And it's all about making sure that, within your portfolio, it's diversified. You're buying good companies, all that kind of stuff. Or if you haven't got time to do any of that, you basically palm it off to somebody to do it on your behalf. It's a difficult balancing act to make a lot of the time. And this is where, in times like this, people do really, really, really find it difficult. Right, let me just get it. Here we go. GT Playboy. Do you think long-term mortgage rates will be offered by more providers and become more popular? Yes, I think so. I think though, I mean, look, who did we have? We had the one that I reported on probably about, this was last year, back end of last year, maybe in I think it was November or December. November, beginning of December was the first one. Then we had Habito in January. So there are two that I know of immediately, straight off the bat, that are offering, mortgages with 10-year fixed rate, 15 fixed rate mortgages. Before any of the other providers come in, I would imagine they'll probably wait and see what the uptake is by the general public before they roll into it. I could be wrong though. You might see some of the banks will just be like, oh, you know what, we can do this as well. Just, lump it in, because, a 10-year or a 15-year fixed rate mortgage is good for the banks. It is really, really good for the banks. I was very, very surprised when Habito didn't have early exit charges or early repayment charges on their mortgage offering, because locking in for a longer period of time, like 10, 15 years, means that they actually can forecast their profits for much, much longer. And when you look at amortization, the way that works, amortization is basically you paying more of the interest up front during the term of your mortgage. They will have a longer period of time where they're recuperating some of that interest and taking that interest up front. So I think there is a possibility that you have more providers come in, but I think they'll probably wait and see what the uptake is and how popular it is with the other providers that have launched recently before that actually happens. So we'll see what happens within that arena. But I think it is needed, because I think there's only one way for interest rates to go now, and that will be up. We're no longer in the 1970s where interest rates are at 12, 15%. We're in a low interest rate environment, and we know that the monetary policy that they're tied into is going to be changing very, very shortly. So I'll be surprised if we don't see more, but it may take a little bit of time. Yeah. Kev's got an emoji. Good man. All right, Mads, let's have a look at this. Mads, if I were to migrate to another country, say Canada or Australia, and be resident there for a year, would I still be eligible for the tax-free ISA up to £20,000? The answer to that is no. By law, you have to tell HMRC when you are moving. So if you are going to be moving, you're going to be resident elsewhere, you need to let HMRC know that you are actually moving in order for your tax records to be updated. And once you do that, you will no longer be eligible for a ISA or to use an ISA because you're not a UK resident. One of the key criteria is that you are a UK resident in order to use your tax-free allowance. So unfortunately not, mate. Unfortunately not. Is it wise to only have one index fund within a SIP or ISA if you're confident in the fund? Well, it depends. It depends on what that index fund is and whether you feel you're diversified enough. I mean, look, if we really get down to the nitty gritty of what this is all about, right? You're trying to build a portfolio that will stand the test of, market volatility, so on and so forth. So the idea is you want something that is going to be diversified, something that is fit for that purpose. If the index fund that you're invested in you feel is fit for that, then absolutely. If you don't feel that it is, then it may be worthwhile having more than one, but the construction of it will be dependent on how long you're looking to invest for, your goals, so on and so forth. So it really depends, mate. It's hard to say without seeing what you actually have. I mean, if you look at some of the providers, and Vanguard is a prime example of this. So look at Vanguard, for example, right? If you look at Vanguard and you look at the Life Strategy Fund, which is essentially a fund of funds, they have multiple um, index funds or ETFs built within that one fund. So they've got S&P 500. They will have global bonds in there. They'll have emerging markets in there. They're having a mixture of their own funds within that fund. So if you look at it from that premise, you may say, well, okay, if you wanted to take a leaf out of Vanguard's book, it isn't prudent to have just one index fund in your SIP or in your ISA, because the question will become, well, how have you achieved diversification across maybe different asset classes as well, right? So I have got my iPad to work today, thankfully, because last week it wouldn't work and I wanted to illustrate a few things. I can do that today. So just spare me 1 second and I will have a look at just sharing this with you so you can see what I'm talking about. All right. Okay, cool. So let me just stretch this so it goes full screen. No, it won't do that. Okay, cool. So, I mean, if you just have a look at, you've got let's get rid of that. 1 sec. You've got a portfolio here. And essentially within this portfolio, you're going to try and fill it. I mean, traditionally, portfolios are built with different, slithers and assets, right? Now, generally, what are we doing? Now, generally speaking, within these, you might have, equities, which will be your stocks, your shares, right? Then your other parts of this will be, bonds. You might have some alternatives in there, which could be things like your oil. It could be commodities, right? You could have those things in there as well. You might have a little bit of cash. You might have a little bit of property in here as well. So if you're looking at building an actual portfolio, you're trying to fill it with as many of these asset classes or asset classes that you feel are appropriate, that will give you the best experience in terms of how you've invested, managing volatility, managing market fluctuations as possible. Now, when you look at all of the asset classes, they all play a different role. This is going to be your engine of growth because you're going to get the most amount of growth from this part here, right? So this is where you're going to see the biggest amount of growth that you're going to achieve within that. This is basically to offset this right here. So it's a diversifier. The same thing with everything else here. Your cash, if you're looking to do this from an active point of view, will be, you might take some profits, put it in here, reallocate it into the market if you see a bit of an opportunity. Then obviously within property here, what you might find is you'll have some property opportunities that will give you a known return of some kind, or at least some yield that will take the pressure of you having to rely on stocks for all of your growth. And this is the key thing to remember. Each one of these asset classes has a role to play. So if you're looking for a return, and let's just say you're looking for an income, for example, right? And you needed something like, and I'm just going to make these numbers up. Let's just say you wanted something like a 7% income, and this is a large number for an income, right? You need a 7% in income to survive each year. Well, you might actually go and get something like, I don't know, a 4% return from equities, but from your bonds, you might get 2%. From here, you might get 1%. The whole point is you're using different asset classes to help you get to this target from a calculated approach, if that makes any sense. Now, it doesn't mean you're going to get it right 100% of the time, but it's taking a calculated risk to try and achieve this goal in the most sensible way possible. So, in answering your question, it's a bit of a long-winded one. Vanguard, if you look at the life strategy funds, they've got different asset. Well, they've got two main asset classes that they're using. They're using equities. They're using bonds. And within even the equities, they're probably going to have 6 or 7 different equity index funds or ETFs for their allocation. So let's just say, for example, you had, the 60%, right? Say this is all equities here. There's 67 ETFs and index fund making up their 60% equity. Then you've got within the bond section, which I'm just going to paint green. Just undo that bit right there. I'm just going to paint this bit green for bonds. They haven't just got one bond. They're probably going to have like 3 or 4 bonds here, you know? So it's all about the research that you're doing, mate. I know that it isn't a straightforward explanation, but hopefully it gives you a little bit of context in terms of how to actually look at these things. This is what the professionals do. They're looking at it from a pragmatic point of view. Where do we think we're going to get the highest chance of success? This isn't a guarantee, but how can we take a calculated approach to building a portfolio that will stand the test of time regardless of what happens? And that doesn't mean you can just set it and leave it. You can if you want to, knowing that you've built it with the best understanding of, right, this is what I think is going to be right. You might need to tweak it, but there's been some rhyme and reason. There's method to the madness of them creating a portfolio in that way. So is it worthwhile having one? Maybe, if you think it suits you. But if you look at it from the book of someone like Vanguard, for example, they don't do that. There's a question here. When do you contribute to lifetime ISA? Is it allowed to use? Hang on one second. Let me just get this one off. Get back on. When do you contribute to lifetime ISA? Is it allowed to use it to buy a house outside the UK? No, you can't, mate. It's only for purchases of property within the UK. You can't use it if you're going to looking at buying a property abroad, unfortunately. So you have to use it for UK property purchases and UK property purchases only. I'm just trying to clear that board before I go on to the next question, where I might actually illustrate some things for you. Okay, Andy. Do you think markets are going to get worse when the Fed announce interest rates in March? The big factor in my mind will be how much of an interest rate they're going to increase by. So the Fed never does anything without being calculated in the approach that they take. So in other words, what I'm trying to say here is they've told us in January 26th, they told us rate hikes are coming. So to a certain extent, it will be priced into the market. What Jerome Powell didn't tell us was how much the rate hikes were going to be by. So everybody at this point, I guess, is working under the assumption that there will be a 0.25% rate hike. However, Jerome, when pressed, kind of said, well, we'll react accordingly at the time. Now, the CPI numbers in America are worse than ours. There was 7.1 or something like that a couple of weeks ago. So if you think about the rate of inflation target is 2%, they are running over 3 times the rate of inflation. So we know that they had an emergency meeting. I think it was on the 14th or something like that. I don't think anything happened at that point, but it was an emergency meeting based off the back of the CPI numbers that came out that week, essentially, the week before. So if we get to March and their inflation numbers are, 8%, 8.5%, I'll be very, very surprised if the interest rate hike is 0.25, a quarter of a percent. I think a quarter percent personally is already priced in. If it's any higher than that, I think the markets will take a bit of a wobble. And the fact that so far we're seeing inflation run way beyond target may mean that we are going to see more of a rate hike. If you look at it from the Bank of England's point of view, when the MPC voted, so the Monetary Policy Committee voted, they won by a very, very, very narrow majority to increase it by 0.25%. I think we were going to go higher. Now, there is a danger, obviously, of raising interest rates too high, because then all of a sudden it's a real shock to the system. And then you start talking about the debt bubble. That's horrible. So the sensible thing is to have a really nice incremental increase, 0.25 each time, but paced out over a period of time. We kind of know what that timetable is going to be, but it's heavily dependent on what the CPI numbers are going to be in the next 3 weeks when they come out before March 16th. If they're higher than expected, I would not be surprised if they actually move a bit higher. And if they do, if it's beyond what the market is expecting, I don't think that that's going to be priced in. So I think you may see that the market will take a bit of a wobble past that. But at the moment, that's all speculation. I don't know for sure, but that's just my thinking. The way the market is it worth me continuing to invest into my VWRL? I'm putting in 1,200 a month. I don't know whether to hold or to keep on putting money in. What's your thoughts? Mate, it's a tough one, really, mate. You've got to do what you feel comfortable with at the end of the day. I can't advise you to continue. I can't advise you to stop, because ultimately you're investing at the end of the day. You can always put money in, get back less than what you put in, and you could have your money go in day one, then the markets then trail off. Equally, you could have the markets do really, really well the day that you put it in. We just don't know. I think ultimately, especially if you're picking, the funds within Vanguard itself, you need to go back to the drawing board and ask yourself, right, why are you investing? How long are you investing for? If you need the money in the short term, maybe 3 years, in the next 3 years, then maybe hold off. Maybe you need to reevaluate what you're actually doing and consider, if you put the money in and you start to amass quite a bit of money, but you need it in 3 years' time and the markets do trail off, are you okay with that? Are you okay to wait? I've made a few videos on this, and I know it's not the sexy thing to say right now, but it is the honest, view that I would like everybody to take and would hope everyone would take. It's really, really hard. You've got to ask yourself the basic questions, mate. Your goal, your timeline, what risk are you willing and able to take? Are you willing to take the risk that you could continue to put in 1,200 quid a month, it tanks, and you're happy to just continue to pound cost average in, buy the dip, to use that phrase, and continue to put the money in and have that soar at the back end, waiting for the markets to return? Are you able to do that? Well, are you willing to do that? And are you able to do that? So the able is the big thing. So do you have really good budget? Hopefully you do. I'm sure that you do, Spencer. Do you have an emergency fund, so that if you're going to put, £1,200 into the markets, cost of living's going up, council taxes will be going up in April, I'm sure. You're going to have energy prices increase, food prices increase, fuel prices increase. Are you able to sustain those kind of increases in costs and still invest that money, knowing that the markets might dip, and not have to call on that money? The risks that you're willing and able to take are so, so, so key. People miss this all the time. And, again, on the podcast tomorrow morning, Jax and I, who's the investment manager, we speak about this because he builds portfolios for people. So when I talk about, let's actually just draw this out, actually, because I think this might be useful for some people. We talk about your risk. What's this thing doing? What are we doing here? What's going on? Okay, let's do this here. So when we talk about your risk, it's not just I'm happy to put the money into the market. That's not the conversation we're having here. It's the risk that you're willing and able to take. Okay. So your willingness is right. If I score 1 to 10, I think I'm an 8, right? That's what you're willing to take. You're willing to go into something that's really, really high risk. You think it's cool. You think you're going to be okay with it. That's a subjective thing, right? This is very, very subjective because it's what you think. This right here speaks more to practicality. So when you look at it in the cold, hard light of day, are you able to take risk at a level 8? So your goal comes into this, your timeline comes into this. So again, and I've said this in a couple of videos, if you're investing for anything less than 3 years, you are not an 8. You are 100% not an 8 because you need your money in 3 years. Therefore, you're not able to take risk at a level 8, which is high risk, with your money needing to be out in 3 years. So your timeline is very, very important here. Then we talk about other practical things. Budget. If you're living paycheck to paycheck, right, you barely have any money left over on a monthly basis, you are not an 8. You are not an 8 because the likelihood is if you needed that money or you needed money and the markets are down, you're either going to go to credit cards, overdraft, personal loans, credit facilities because you haven't got an emergency fund, which is the next thing. Emergency fund. These two things right here are your absolute foundation. If you don't have these two things, investing, you've got to get these two things before you start investing. This is all about the risk that you're able to take. Now, if you've got all of these things in place, so you know what your goal is, boom. You're investing for more than 5 years, boom, perfect. If you've got a really robust budget, you know that you're investing disposable income, perfect. If you know that you've got an emergency fund of whatever amount that you feel is comfortable, typically 3 to 6 months worth of your expenses at a very, very minimum. If you've got all of that, then yes, you are an 8. But if you can say no to any one of those, you're not. Really, 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 really important fact to remember. Like the professionals, when they're building portfolios for clients, this is what they're talking about. And it's not there to be boring. It's not there to kind of prevent people from making money. It's taking a pragmatic approach, looking at both sides of the coin. So whether you should continue to invest in the VWRL is going to be dependent on the risk that you're able to take and the risk that you're willing to take. But obviously, from a practical point of view, looking at the able to take column as the paramount factor in this equation. Kevin saying Russia won't go to war. Vali's talk is, you know what, mate? I'm not too sure. I think there's show of force, and there's certain things that's going on at the moment. I think what Vladimir would love to do is provoke Ukraine in the action first, and there's rumors last week of their banks and their financial system having cyber attacks. You know, the Russians are very good when it comes to cyber warfare. They've amassed 130,000 troops. You don't do that without an intent, or at least a show of force. And I think it's just a show of intent. I think if they're able to provoke Ukraine, that would give them all of the excuse that they basically need, because they'll say it's self-defense, so on and so forth. But who knows what happens? Look, we're talking about war here at the end of the day. It's no light subject to kind of talk about in a nonchalant way. I hope it doesn't go anywhere near that, but it doesn't look good right now. And yeah, it just doesn't look good right now. Anil, how you doing? PM's here. Okay, let me just follow up on this one. Spencer, man, listen, I would not be buying just 2 to 3 stocks right now. Absolutely not. Like, diversification is so important right now, especially if the choice is buying something like the VWRL or putting money into 2 or 3 stocks. Terrible choice to be making. terrible choice to be making. Um, Consider what I spoke about earlier. Like, you need to understand what your goals, what your timeline is, the risk that you're willing and able to take is, because that will dictate what you end up buying. But if the choice is either put money into the VWRL or two or three stocks, that's a really, really bad choice, really, to be fair. Unless you're happy with, like, you know what, we put it in, we're happy to gamble it. If it goes down 50% tomorrow, I don't care, then by all means. But if that isn't the case, which I'm guessing it isn't, that it's not a great choice to be looking at, mate. It really, really isn't. Um, yeah, it just isn't. Saeed, how you doing? Okay, let's have a look at this question from Saeed. I'm looking to speak with some accountant about starting a new business, but my budget is very low. Do I have a chance? Do you know anyone? Um, do I know any accountants that basically do business consultation? Yes, I do. At least I think she does still. I'm pretty sure she does. No, she does. If you message me, mate, I don't know what her rates are, but I could probably put you in touch with somebody that I've done some work with before, who can help you. So if you're on IG, mate, message me on IG, and I'll do an introduction on IG, because yeah, she's very, very good. She's a qualified accountant, and I know that she does business coaching, and she helps people set up business and helping with like cash flow models and all this kind of stuff. So yeah, message me on Instagram, mate. Conversation of Money, and I'll do an introduction to you there. But again, I don't know how much she charges. Ian. Okay, so maybe this is an update that I didn't even know about. I see Trading 212 allowing UK customers now, and I've signed up now, but I've heard the horror story about them lending out your shares to others. Would that put you off using it? Look, to be fair, most of the providers who have a free offering all do that. They will all lend out your shares to other people. Look, at the end of the day, mate, they've got to make their money somehow, and you're paying zero to use them. So how they make their money is by lending your shares to somebody else. If you're not paying for a service, you become the product that essentially that they basically use. So do I use them? I have got money with them, but they're not my primary provider when it comes to buying any of my individual stocks. Not really. I don't. But I think if you're going to be using Trading 212, it's just really, really important to know that those are the terms and conditions. Most of them do this. I think Free Trade do it, but Free Trade have better language around how they protect you and all this kind of stuff. Do Stake do it? I think they do. I'm not too sure. But most of them, if it's free, they will have this. They have to make money somehow, mate. Because unfortunately, running a company like that costs a lot of money. Like the amount of times that I see people complain about the fact that there is you can't speak to anybody at Trading 212. Well, it's free. If they're providing a free service, they're not going to invest levels of money into a customer service call center for you to pick up the phone and ask them questions. They're just not going to do it. This is the trade-off that we have using free apps. You're either going to trade something, you're going to trade yourself off for being a product that they will then obviously go and monetize in other ways, or you're going to trade off customer service in some way, shape, or form. There's always a trade. They're not my primary source, but as long as you're using them and you're happy with the terms and conditions, and you're happy with the fact that actually, if you needed to ask a question, you probably won't get a response from anyone, then by all means use them. But when we talk about this level of what the offering is from a customer service point of view, these kind of things do matter, because if you run into any trouble, I would imagine that you want to speak to somebody. You would want to be able to have a conversation and get a response from somebody. It's just hard for them to do from a business point of view if the service is completely free. I know they make a lot of money on the CFD side, but you know it costs a lot of money to provide that kind of service. So yeah, but I don't use them as my primary mates. Just make sure you're happy with the terms and conditions, man. I know it's a really, really tough decision, but maybe, I don't know, compare providers as well. See what other ones you have available. and pick from there. All right, guys, do me a favor. There are only 28 likes on this video so far. So you can really, really, really show me some support. If you can absolutely smash that like button for me, please. If we can get it up to 40, so at least up to half of the people that we have on here right now, that will be absolutely amazing. We just need 12 more to make that happen. Cheers, guys. All right, okay, cool. So let's have a look at Michael. Nearly coming up to my first full year of being invested. Thank you for all the information you have applied in lives and videos. I've upped my pension and invested monthly and overpaying mortgage. Mate, I love this. Music to my ears. Graphic that. You're on Instagram as well, aren't you? Yeah, I'm sure you're on Instagram because I recognize the username. So, mate, listen, it's good to hear that. Thanks for obviously watching and tuning in all the time. Thank you. I love it when I see conversations in the comment section here, because obviously there's so many of you who actually rock up on a weekly basis. It's nice when I see, you know, somebody saying hello to somebody else because they recognize the username from like the previous lives. I love that, and I know there's a conversation going on at the moment between Edna and Food Dweller. This is the kind of stuff that I like. It's really really cool. Let's get this one before actually I talk about this. I was gonna try and do it yesterday. What was yesterday? Was it yesterday? What? No, yesterday was Saturday. On Friday, I've got a Discord group being built in the background, um, and I want to get it set up properly so that it's not just a group where we can congregate and we can have comms and talk and questions and all this kind of stuff. I want to have it set up properly. Um, I was hoping to be able to announce it on Friday, but it just didn't happen that way. I'm going to announce it as soon as I possibly can. But within the group, we're going to have like access tier levels and all that kind of stuff. We can have like voice rooms in there and all that all those kind of things. We can update you about what I'm doing, all this. It's going to be really, really cool. I was hoping to announce it on Friday, but it's just been absolutely mad. So I've not been able to, but that is coming down the track just as a heads up for everyone. Um, okay, Ian, I've heard that before, but Trading 212 are covered by FCA. I'm not worried to that. I'll be spending my money. So this is an important thing to remember. The FCA, the Financial Services Compensation Scheme, is only if the company goes bust. So mismanagement, bankrupt, that kind of stuff. It does not cover you for investment losses. So really, really important distinction to make. So for example, if they lose money, they lose your money because they've lent it to somebody else. That's not covered under the FCA or the Financial Services Compensation Scheme. That 85,000 pound protection is not for that. The 85,000 pound protection is if they go bankrupt, they disappear off the face of the planet, and it's mismanagement, that kind of stuff. It does not cover you if they've lent money to somebody or your shares to somebody and there's been losses. It does not cover investment losses in any way, shape, or form. Just to be clear on the Financial Services Compensation Scheme. What are my thoughts on Mattioli Woods? All right, this is a good question. Mattioli Woods. So I did a little bit of work with Mattioli Woods. They've got a really, really good advisor academy, apparently, for what I've heard. Yeah, they're based over in Leicester. See, you get mixed reviews about companies. I know that they do a lot in the REIT side of things to varying success. Like some of their projects will do okay, some projects will do badly, and then the negative returns for the clients and stuff like that. But again, I don't think that you can get it right 100% of the time. If I have to look at them from just the general reputational point of view, from me having dealt with them, they have a good reputation. But there are underlying kind of like murmurs and points of dissatisfaction that people often share. So I would say if you're going to use them, make sure you do your research and make sure, obviously, they're a firm of financial advisors, so you should be able to sit down with somebody. Um, don't don't be wooed by a financial advisor. If they're looking to, take you out or things like that. Don't get wooed by any of that stuff. Really pay attention to some of the substance and ask questions and see how they respond to you. If I were you, I'd try and ask some very difficult questions as well to see how they respond. Are they forthcoming, or do they get a little bit defensive? Those kind of things really do matter, because if you're going to use somebody, if things get tough and you have to ask a difficult question and they get defensive, is that really what you want? But generally speaking, their reputation has been good from what I've gathered, just working with them and from general interactions. But yeah, there are murmurs of dissatisfaction with certain things, but every company has that at some point. It's very, very rare that you're going to have customers that are 100% happy 100% of the time. So Ian, mate, thank you so much for the super chat. Really do appreciate you. Thank you very much. I'm conscious of time. I'm going to give this another maybe 15 minutes or so. Um, Let's have a look at this one. To Wallace, can you discuss equity REITs versus mortgage REITs? Which would be better inflation hedge? Do you invest in any REITs or employ any inflation hedging tactics? Thank you very much. Right, okay, that's a massive, massive, massive topic. I probably think about doing that maybe as a video topic specifically. Um, because yeah, that's a big, big topic. We'd have to go into what equity REITs are, what mortgage REITs are separately as an individual, talk about the pros and the cons of each of them, then have a look at how they might actually work as a strategy to hedge and what the pros and cons of actually doing that would be. So that's quite an in-depth one. I'll have to note that down as a possible video to do. Let me just write it down 1 second, mate. Equity versus mortgage. All right, that's down. I'll see what I can do in the next few weeks or so as a video for that. Where am I? There we are. Okay, cool. Elaine, let's have a look at this. I have £5,000 to invest. Any suggestions, Pete? Bear in mind, I am a weary investor. Have to say, if you have money to invest right now and you are weary, then I would strongly advise you to have a look at employing somebody to actually invest the money on your behalf. Because I doubt very much that you'll be the kind of person, if you're very wary, who will be able to make or will be confident in making a decision about picking a particular fund or a number of stocks and being able to sleep at night knowing that you've done a good job and you're okay with the decision that you've made. I would probably task that off to some professionals. Wealthify, for example, they're sponsoring my channel for the next 5 months. Someone like them would do really, really good. The trade-off is you are going to pay a little bit more for their service. But that's the whole point, right? If you're not confident in actually picking something on for your own accord that you're 100% happy with, knowing that you've done the research, knowing that you know what you're going to do in certain contingencies, then employing the skills of somebody else who have a team of people who are able to do that on your behalf may just be worthwhile in terms of a value exchange to help you sleep at night for the £5,000 that you're going to invest. Now, obviously, that does not mean that they're going to get it right 100% of the time, but they'll probably do a better job than you would if you were to try and manage it all by yourself. So I guess it's a choice there. And if I had to give you any suggestions, it will be maybe have a look at a provider like that. Maybe shop around a little bit, do comparisons, try and speak to them, try and read up on them a little bit, have a look at some of their websites and all that kind of good stuff, and try and make a decision from that point of view. But I strongly believe that it's better for you to employ somebody like that than try and guess and fumble through it on your own, and then you make a mistake, and then all of a sudden you're down £1,000 when you didn't need to be. You know, it's taking a pragmatic view. Highest inflation we've ever seen. No, I mean, this is the highest inflation we've seen for 30 odd years. I mean, the inflation numbers haven't been this high since what, 1992, something like that. So it's a 30-year high at this point in time. But if you go back to, the 70s, inflation was pretty high back then. I mean, interest rates were, for mortgage, 12, 15% back in the Thatcher days. And it's way before my time, but I do remember reading about times like that. But we're at a 30-year high right now with the inflation numbers at 5.4. And like I said at the top of this stream, we're likely going to be hitting 8% by the time we get around to April. So there's a lot of pain coming down the line, especially with the energy price caps also coming off too. You know what? You need to listen to the conversation me and Jax have on the podcast tomorrow, because he calls it vibes, basically investing on vibes. And look, YouTube is a great place. YouTube has been good to me as a creator here on this platform, but there is a lot of vibe investing going on YouTube. There's lots of it. There's so much of it. Yeah. It's hilarious, but it can also be very, very dangerous, like you say there. And I think a lot of people who have invested based on vibes and vibes only are now looking at the markets thinking, "Oh my god, what have I done? Have I done the right thing?" And then trying to make sense. And there's nothing wrong with that, because at the end of the day, we've all got to learn through our own experiences, right? And most people learn by doing. But sometimes it can be a very expensive lesson to learn, and it doesn't have to be that expensive. The issue is that because the vibes are all about making lots of money quickly, and it's more superficial than kind of anything that's tangible, it's easy to buy into. It's hard to sell a tangible dream. You know what I mean? Like something of intrinsic value. It's hard to sell that. It's very easy to sell the idea of a Rolex and Lamborghini and luxury items. It's so easy to do that. I mean, I could do that very, very easily if I wanted to on this channel, talk about my car and talk about Rolexes and all this kind of stuff. I choose not to, because I don't want to attract necessarily those kind of people. And I think that for my brand and what I want to be known for, I don't want to be known as a hype merchant. That's not me. It's not actually my lifestyle. I don't live that lifestyle. I don't feel the need to, and I don't feel the need to justify or show off. What does it matter? What Rolex I wear and what car I drive. It makes no difference whatsoever. Some people think that, you should take advice from people who are successful, but successful is subjective. I've done very, very well in the career. I've done very, very well in the past. I'm doing very, very well right now. But some people, that isn't success. Success to some people is, you got to be turning over 300, 400, 500. You need to be a millionaire. Okay. If that's your ideal of success, then there are plenty of people here on YouTube who are professing to be millionaires who will happily sell you their 2, 3, 4,000, 5,000 pound course. Happily sell you those kind of things. I'm not that kind of person. Not because it wouldn't be nice for me to sell like a 2,000 pound course. Absolutely, I would love to sell a 2,000 pound course if it had value to it. I just think that it's criminal of me to be on YouTube talking to people about how to begin investing than to basically sell a course for £2,000 on how to begin investing. It does not stack up to me. And it's the reason why people who are looking at, property, for example, they spend £10,000 on a course to learn about property. And to me, my mind is just blown, because I'm like, hang on a second. So you spent £10,000 on a course, but that £10,000 is probably a good chunk of a deposit for your property. So you can spend £10,000 on a course to learn how to source deals and get other people's money so that you don't have to use your own. It's so counterintuitive. It's so backwards. I just don't get it. And I'm not about that hype. I'm just not. I'd rather not make any money at all than to sell people that kind of stuff. It doesn't ring well with me at all. Great time to invest in Ukraine. You know what? I laugh, but I'm sure, and I said this last week, there'll be people who will be quite open to investing in Ukraine, looking at opportunities right now. I'm sure that there will be investment people who are looking at, right, if this happens, this is the opportunity they'll be looking to invest. But that will be through deep research, really knowing the country, knowing the region, that kind of stuff. So, yeah, there's a conversation in here going on about Klitschko. Yeah, I mean, one of them is Vitaly is a mayor. Hmm. This is a good question. Okay, is it possible to borrow money from your pension, for example, to finance a business? No, not at this point in time, unless you're over the age of 55. So if you're younger than 55, no, you can't access your pension. If you're over the age of 55, you'll have access to your tax-free cash, which means you could take a quarter of whatever's in your pension completely tax-free and use that for whatever purpose you want. If you're over 55, then yes, you could. But if you're not, then no. So how that would work is, let me just see if I can illustrate this again. I don't want to allow that. 1 second, guys. Let's get rid of this. And again, I talk about pensions, and I'm so passionate about pensions because it's like a little bank account that you can build and have access to, which is just great at the end of the day. So, right, so let me just draw this out. Right, so this is your pension pot, right? Could put a P in here. Actually, let me just put full pension in here. So this is your pension pot right here. Now, let's just say you have £200,000 within your pension pot, and you've accumulated this through contributions into your pension your entire working life, right? This right here is going to be the source of your income when you finally retire. Now, under UK legislation, okay, at this point in time, at 55 years old, you have access to something called tax-free cash, or your pension commencement lump sum. And what that allows you to do is essentially take a quarter of the value of this pension pot tax-free. So in this example, that's 50K. So if you are 55 at this point in time and you had a 200K pension pot, you could take 50K completely tax-free. And you can do with that what you want. So if you wanted to go buy a house, you could. If you want to go and buy a Ferrari, you could. You want to go buy a Lamborghini, you could. You want to go buy a Rolex, you could. If you want to use it to finance a business, you could as well. But you have to be 55. That is the magic number. If you're below the age of 55, unfortunately, you can't. All right, let's see what else we've got here. Claudio. Is it possible to move share portfolio from one provider to another? What's the process like? I've not heard of a process where you can actually just transfer it over. Because if you've got it with Hargreaves Lansdowne, for example, and you wanted to move it with eToro, then you're gonna have to sell everything down, which could mean capital gains, chargeable events, that kind of stuff. I've not heard of you being able to move or transfer portfolios with the holdings essentially intact. I mean, you can do it within an ISA. If you've got an ISA account, you can transfer ISAs. I mean, but ISAs are tax free. So whilst they'll transfer it, and what they do within an ISA, which is different, and I was speaking to someone about this when we had a coaching call over the weekend around transferring ISAs between providers. You do an ISA transfer in the way that it's designed to be done at the moment because of the tax-free allowance and the yearly allowances that you essentially have. So, for example, if you had, let me just illustrate this really quickly. And again, I'm just going to use a box for this, right? So, if this is your ISA, and let's just say you have 50K in this ISA right here. If you were with, let's just say you're with Hargreaves Lansdowne, right? And what you wanted to do is you want to transfer it from Hargreaves Lansdowne and you want to take it to, so for example, to Wealthify. Okay. Now, you would do a transfer for this money, and you would ask Wealthify to transfer it for you first. The reason for that is your ISA allowance is 20K. So you've got 50K in here. If you withdraw this 50K, put it into cash, then try to pay it into Wealthify, what's going to happen? Your allowance is 20K. So you've got 30K that you can't pay in. So they do ISA transfers because basically it keeps the amount that you have within the ISA with the current provider intact and lets you bring it over here without breaching the tax allowance. That's how it works for ISAs. So yes, you would have, with Hargreaves Lansdown, you might have an index fund, you might have an ETF. They will get sold. But essentially, because it's in an ISA, there's no capital gains tax, there's no income tax, so therefore there's no tax implication whatsoever. So it means that the transfer is a lot easier. Well, it's not easier, but it's justified in the fact that you've got the tax benefit. If this isn't an ISA, however, right, and you've got an index fund or an ETF in here, I don't know of a transfer. So you've got ETFs and you've got index funds in here. You haven't got the ISA limit, so that's completely irrelevant. But you just want to go from Hargreaves Lansdown to Wealthify, for example. That portfolio will have to be sold down. You'd have to sell all of this. They'll have to be bought over here. So that means that potentially you'll have a tax event, possible capital gains tax, potentially, depending on how much you're transferring over and what your gains have been. But I don't know of any process that will allow you to do a clean transfer from one to the other that I'm aware of, Claudio. All right, I think we're almost through the questions, or am I wrong? Have I just skipped down? I think I went down a little too far. Okay, all right. Bear me 1 second. Let me just have a look at this quickly. Let me just have a really quick skim. I've got 2 hours worth of work that I need to do. Then tomorrow I'm up early. I've got to do some work for Pension Bee for their podcast, and then Tuesday I'm in London. Then we're shooting Wednesday, Thursday. Then I'm back on Friday. So I've still got 3 hours worth of work I need to do tonight to be in good stead for tomorrow morning. So let me just skim the remaining questions that I've not actually got to see if I can pick up maybe 1 or 2 of those before we actually sign off. Okay, let's have a look at this one. Should I be concerned that I have a negative interest rate on my stocks and shares contributions? I've been investing for almost a year now. So Esther, what I'm guessing you're alluding to there is you've probably put in, say, £2,000 and it's now saying it's worth, I don't know, 1,900. Don't be. As long as you're investing for the long term and you're happy with what you've invested in, the markets will go up and down, unfortunately. That's just the way the markets work. Sometimes you're going to see your portfolio in positive territory. Sometimes they're going to be in negative territories because it depends on what you're invested in. It's all part and parcel of investing. So you don't need to panic in any way. You don't need to be concerned. But I would ask you the question, when you look at it in a negative, with negative values, you've lost a little bit of money. Does it make you panic? I mean, you're already there now, essentially, and we don't know what's going to happen moving forward with the markets. It is completely and utterly normal that this happens, but it's all about how you view it and how you cope with it. That's the most important thing, really. So don't be concerned, but just be prepared that it could go even lower. And if that freaks you out, then you need to make a decision as to whether you continue with it or whether you take it out. But you'll be crystallizing a loss. It's really, really hard for me to say that, but it's the truth. It's just the way the markets work. They go up, they go down. You've got to be happy with the ride, essentially. Oh, cheers for this, guys. Appreciate it. Thank you very much. Yeah, there are. I think there's over 200 and something odd videos on here now. There's a lot of content. So If you do have any questions, obviously this is where we take questions every week. But yeah, if you get through the content, you can message me on IG and stuff like that. I'll see if I can get round to the questions on IG. I try to. I can't a lot of the time, which is why I dedicate the time to do this on a Sunday evening. But yeah, hopefully you'll find the content useful. All right, this is a good one. Is it wise to raise my pension risk of Scottish widows from medium to high since it's a long term investment? Yes, it can be. Absolutely, it absolutely can be. Especially if you're young and you've got your retirement in 10, 15, 20 odd years time, then you want your money to be working as hard as possible for you, as long as you're happy with the fact that obviously with the potential for high rewards, you get the potential as well that in volatile markets just like this, it could swing quite heavily into the losses. But if you're investing for 15, 20, 25 odd years, it doesn't really matter, because over the long term, you're looking for the long term market return. So it's essentially just a blip in the road. But as long as you understand that equation, then you should be fine. All right, okay, let's have a look at this. This is really good. I have enough for an 80% deposit on a property. I want to buy the house next year, but my capital in the stock market, but my capital is in the stock market with ETFs. If the markets ain't safe, where else can I put the money with inflation? Mate, listen, you are in an enviable position. I guarantee you right now, there will be other people who have just heard me read this and will be hearing me read this on a replay, who will be like, you lucky what's it. Look, if you've got an 80% deposit for a house, look, the idea of having investment returns is great, right? Obviously, it's nice if it can make you a little bit more money. But the goal here is the house. It's not the investment returns. The goal is the house. So if you've got an 80% deposit and you want to buy next year, I mean, you could probably buy this year. I'm guessing you maybe want to buy outright, which is a dream for most people. But I think it's really important to keep an eye on the actual goal. The goal is the house. So, in answering the second part of your question, where do you put it? There is no way that you could put it that will be cash bearing, that will give you anything to combat inflation effectively, because inflation numbers are just way too high. I mean, if we get to 8% in April, there is not a bank account in the land that is going to give you 8%. You'll be lucky if you find one that's going to give you 1%. But what you could do in terms of putting it somewhere that will be relatively safe, so you don't run the risk of losing part of that 80% deposit and then feel like you've lost ground on the house that you want to purchase, you could by all means do something like NSNI bonds, for example. I mean, that's tax free. There's barely any risk. There's no risk within that at all. And you might win on the weekly draws. I was speaking to someone a week and a half ago with coaching. She was getting 25 quid, 50 quid, 75 quid almost every other week. And it's like, happy days. Like, before you know it, you win two or three of those. That's a pretty decent return. Yes, it's luck of the draw, but how is that any different to the stock market? It's also luck of the draw. Depends on what happens with the market on any given time. Yes, we try to calculate the risk and make an informed decision, but it's pretty much exactly the same thing. So what I'd say, mate, is keep your eye on the actual goal. The goal is the house. You're in an amazing position to have an 80% deposit. And I hope I'm reading that right. I hope you typed that right. 80% deposit. You could go and buy a house now if you wanted to and have a very, very low loan to value. Your mortgage payment would be nothing. Really. You could. So the prize is the house. Go put it in an S&I bonds or something. Get the luck of the draw with the weekly draws. You get 20 quid, 50 quid here, 100 quid there. I think the maximum you can win on NS&I is a million quid, I think. I'm pretty sure it's a million quid. You probably won't, but if you did, hey, happy days. Come back. Let me know that you did. We can have a little conversation. But anyway, look, 25 quid, 50 quid there, it all adds up. I would say go and put it there. And there's a follow up here that you're saying. Also, if I leave it in the market for more than a year, I'll be guaranteed at least another £600 in dividends and possibly some appreciation. What should I do? Um, you will be guaranteed at least another £600. I mean, we're talking about the markets here, so there are no guarantees, mate. I mean, what happens if in the meantimes, the company that you're invested in, they reevaluate their dividend payments? Because they can do that. They may half dividend payments. Companies do that. There are no guarantees or so. I mean, look, at the end of the day, you've got to make the decision that you feel is right for you. But I think, sometimes people get mixed up and lost in the idea of trying to get as much in terms of an investment return as possible, completely forget the reason why they're investing in the first place. You know, if you've got an 80% deposit, mate, the house is the big deal here. You're literally in touching distance of it. Touching distance of it. What does an extra 600 quid really mean? I mean, look, this is the way I think of it. So this is just my point of view that I'm putting across. And in my head, if I'm thinking, I want to buy a house, I've got an 80% deposit, what's another 600 quid? Is another 600 quid worth the risk of me potentially, the markets might fall off and then my 80% deposit becomes 75 for 600 quid? For me, it doesn't compute. I don't know. That's just my opinion, though. It may sound silly, but how can we find a financial advisor? Really, really simple. There are websites like on bias.com that you can go and have a look at. They should give you, you'll be able to search for a financial advisor local to you by postcode. To be honest, though, a lot of financial advisors do have minimum investment values that you have to meet. So they'll be like, oh, if you don't have 50K to invest, we're not going to go see you. It's why I do what I do now with coaching, because I know fully well that there are a lot of people who have got 30 grand, 40 grand, and 50 grand for some advisors, the very, very minimum. I know advisors who will not even get out of bed if you haven't got 200, 250. And the reason for that is because it is expensive to have your own firm. I mean, by the time you paid FCA registration fees, compliance fees, insurances, it's a big, 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 big ticket, like every year to know that you've got to pay. So warranting a client value of X amount for businesses that are large, they have to have those things in place. Is why I do what I do now with coaching, because I know that there are a lot of people who will have 30 grand, 40 grand, 50 grand that financial advisors won't touch, where coaching is actually a really, really good fit for them, where I can kind of cover the things that a financial advisor would cover in terms of downloading the train of thought, so that you're able to, look at your situation from how a financial advisor would look at it, in order for you to make your own informed decision. That's why I do coaching now, and I don't advise anymore. But if you want a financial advisor, unbiased.com, I think it's called, unbiased.co.uk, you can use that. Or if you would like a introduction to someone who I know I've worked with quite a bit, who would do a really good job, then just message me and I can do an introduction as well. All right. Okay, cool. It gets longer and longer and longer. Guys, I appreciate you for being here. It's now 15 minutes coming up, roughly. Yeah, I'm trying to keep up with the content next week and the week after. It's pretty intense. It really, really is. And yeah, it's just me doing this, and I wish that I had a videographer or an editor or someone like that to help me out. The guy that I was going to use, he's currently out in Switzerland, so he's away at the moment. But yeah, it's very, very intense at the moment in terms of my schedule. It's very, very busy. I'm going to try and keep up. There might be shorter videos, or some videos that will go over maybe some of the old stuff that I've covered, but mainly in new language and updated for the time where we are right now. But yeah, the next couple of weeks are going to be very, very busy. We'll do these on a Sunday still. But yeah, during the week might be a little bit light. But guys, I appreciate every single one of you for being here. Again, Ian, thank you so much for the super chat. If you're watching this on the replay, I will see you on Tuesday. The video for Tuesday is already scheduled. So I just need to get ahead of myself for Friday and for the videos next week. I kind of have an idea what I'm going to do. It's just putting it all together. But guys, have a good evening, whatever it is that you end up doing, and have an amazing week as well. Catch you later on.